Hello everyone. I thought I would make a video on the subject of interest rates and the coming seemingly global interest rate cuts that almost every country in the world seems to be imposing upon its beleaguered populations. Beginning with the US. Is this an economy gone mad? Suggests MarketWatch. The Fed is going to cut interest rates despite record stock prices and low unemployment. July the 13th. Consider stocks are hitting record highs and layoffs and unemployment is at 50-year lows. Yet the Federal Reserve is prepared to cut interest rates soon because it's worried about the economy. Global growth has slowed, said Mark Heffler, Global Chief Investment Officer at UBS Global Wealth Management. The various trade disputes and tariff hikes have created uncertainty and makes it more difficult for for businesses to commit to investment, he says. But not everyone is impressed. Many economists are skeptical that a small reduction in already low interest rates will do anything to spur borrowing or help the economy. Credit is cheap and readily available, and it has been for years. His case for easing is focused almost exclusively on the uncertainty caused by trade negotiations and the resulting drag on business confidence and investment, said frequent Fed critic Stephen Stanley, chief economist at Amherst Pierpoint Securities. I find the case for easing incredibly weak, he said. Just 7 months ago, remember the Fed was predicting it would raise interest rates several times this year. Not anymore. Now the question is just how many times it will cut rates and whether it will do any good at all. So, Fox Business, the Fed is poised to cut interest rates, but how much will they drop? 12th of July. In the face of growing uncertainty, policymakers at the US Central Bank are prepared to lower interest rates at the upcoming July meeting. Although Wall Street was already pricing in a 100% chance of easier monetary policy, the news still sent stocks soaring, with the Nasdaq Composite notching a record high. CME's FedWatch tool, which analyzes the probability of rate movements for upcoming Fed meetings, is currently forecasting a 78.6% chance of a 25 basis point cut, lowering the benchmark federal funds rate between 2% and 2.25%. Meanwhile, about 21.4% of traders are pricing in a 50 basis point cut, which would drop borrowing costs between 1.75% and 2%. A study conducted by LPL Financial Research revealed that steep rate cuts generally occur around recessions. For instance, since 1990, the Fed has cut rates by 50 basis points or more, 18 times. Only 7 of those cuts took place in the midst of an economic expansion, but 6 of those 7 were in the 1 year period before or after a recession ended. Moving on to Australia. This is from The Guardian, 20th of June. Australian interest rates head for 1% as emergency measures loom for economy. Interest rates are heading for unprecedented lows below 1%, and the Reserve Bank of Australia could even be forced into extraordinary measures such as money printing to stimulate the struggling economy, forecasters believe. NAB economists brought forward the expectations of a cut to July from August and said the deteriorating economy would force the bank to keep on acting, perhaps even introducing QE in 2020. Chris Weston, strategist at Pepperstone, a forex trader in Melbourne, said the market indicators were already predicting rates to land at between 0.5% and 0.75%. If rates go below 1%, we start talking about a currency. At what point do we talk about QE? So forget about rate hikes for a long period of time. Independent economist Lindsay David of LF Economics said he would favor a move to QE before any rate cuts because it would have more impact on the economy, which was suffering under the strain of falling property prices. He said the RBA governor's remarks betrayed serious concerns. Something severe must be happening for the RBA to be firing the few bullets they have left. Australia is facing recessional headwinds. Stock markets around the world and in Australia responded positively to the prospect of lower rates, with cheap money likely to be thrown at buying shares in the hope of higher yields than those on offer from banks. Wall Street's S&P 500 leading index is close to an all-time high, while the ASX 200 in Australia rose for the third straight day to close at a new 11-year high of 6,687.4. And this is the very statement from Philip Lowe, Governor of the Reserve Bank of Australia, the 2nd of July. At its meeting, the board decided to lower the cash rate by 25 basis points to 1%. This follows a similar reduction in the board's June meeting. This easing of monetary policy will support employment growth and provide greater confidence that inflation will be consistent with the medium-term target. The main domestic uncertainty continues to be the outlook for consumption, although a pickup in growth in household disposable income is expected to support spending. Today's decision to lower the cash rate will help make further inroads into the spare capacity in the economy. Moving on to the Bank of England. Bank of England could cut interest rates to near zero in no Brexit deal. That is 12th of July. Gurjan Vinga, a member of the bank's rate-setting monetary policy committee, told an audience in London today that Threadneedle Street might have to slash rates to nearly zero in the event of a no-deal Brexit. Now, there's a lot of FUD about a no-deal Brexit, but and up till now, the Bank of England has remained staunchly against rate cuts, but that's dependent on a number of factors, and the uncertainty around Brexit is bound to be an influence. So if they feel the economy needs more stimulus, rate cuts are the first thing they will turn to. And likewise in China, as we shall soon see. Turkey, July 14th. Erdogan says Turkey will make serious rate cuts. President Erdogan said Turkey will make serious cuts to interest rates. Broadcaster Haberturk reported on Sunday, a week after he replaced the governor of the central bank. Erdogan said Turkey aimed to reduce inflation from more than 15% to single digits by the end of the year, and also had a target for interest rates over the same period. Turkey's benchmark interest rate was hiked to 24% last September to stem a sharp fall in the lira, the Turkish lira that is. The central bank has left it unchanged since then as the economy tumbled into recession to prevent renewed losses in the currency. Economists expect the central bank under the new governor, Murat Usil, to cut rates by 200 basis points at the next rate-setting meeting on July 25th. India. Expect RBI, that is the Reserve Bank of India, to cut rates fourth time in a row. And that is July 13th. A Kotak report on Saturday said it expects the Reserve Bank to cut policy rates for the fourth time in a row in the next Monetary Policy Committee meeting due in August. The third consecutive rate cut, announced in June, was the first time since 2013 amid a widespread slowdown in the economy. Government's adherence to fiscal prudence and MPC's acknowledgement of the fading growth impulses strengthens our belief of another 25 basis points cut in August. Further cuts would hinge on the growth inflation mix. So, July the 1st, Lane says ECB has scope for interest rate cut. ECB chief economist also says bank could resume bond purchases. The European Central Bank's new chief economist used his first speech in the role to claim that past monetary policy stimulus has been effective and that more is available if needed. Philip Lane, who joined the executive board in June, echoed President Mario Draghi's recent remarks that there is room to cut interest rates from record lows, to resume bond purchases, to boost inflation amid the current economic slowdown. The Eurozone is struggling under a manufacturing downturn driven largely by global trade tensions. A gauge of factory activity published on Monday showed factories are still stuck in a slump. It is essential that the central bank shows consistency in its monetary policy decisions by proactively responding to shocks that might delay convergence to the target or move inflation dynamics in an adverse direction. Investors and economists predict that the ECB will cut interest rates as soon as this summer. The deposit is already at record low minus 0.4%, and the central bank only capped its 2.6 trillion euro quantitative easing program at the end of last year. Mr. Lane said the ECB's latest adjustment to its communication on interest rates, a pledge to keep them on hold through at least the first half of 2020, was not intended to ratify market views. Rather, it offers an idea of the most likely path foreseen by the Governing Council, given the current state of the economy. So, they're saying inflation rates have been disappointing, and they're considering lowering interest rates and resuming quantitative easing, or at least bond purchases, to stave off deflation, which is every Keynesian economist's nightmare. Moving on to Japan, July 22nd. BOJ's Kuruda says will mull impact of global uncertainty on economy. Bank of Japan Governor Haruhiko Kuruda said on Monday the central bank will pay close attention to the impact heightening global uncertainties and jittery market moves could have on Japan's economy in guiding monetary policy. Kuruda also said central banks do not need to be too pessimistic about their ability to stimulate the economy with additional monetary easing, even if faced with a substantial decline in the natural rate of interest. As central banks shift to a more dovish approach on monetary policy, some market players expect the BOJ to ease as early as its rate review this month to prevent heightening global risks from derailing Japan's economic recovery. While preaching the benefits of unconventional steps, Kuruda warned it was not easy to continue with powerful easing for a long time due to the pain it exerts on financial institutions' profits. In theory, central banks can provide monetary easing effects by affecting people's behavior with a commitment to keep policy ultra loose for a long period of time, Kuruda said. In reality, however, people's behavior does not seem to change as much as the theory suggests, especially when the forward guidance horizon becomes longer. Now, it's worth mentioning here that Japan has one of the most aging populations in the world. And aging populations just do not spend that much. And as a consequence, they always tend towards deflationary inclinations. Continuing, under a policy dubbed yield curve control, the BOJ pledges to guide short-term rates at -0.1% and the 10-year government bond around 0% via heavy asset purchases. Japanese-style interest rate caps are drawing interest from global central bankers worried about a downturn, including US Federal Reserve officials grappling with how to bolster their options as prospects for the global economy darken. Kuruda said YCC could be something other than central banks could adopt in the future if they are stuck with subdued inflation and low interest rates for a prolonged period. He noted that conventional wisdom argues that central banks should not try to control long-term interest rates, but with short-term rates at the zero lower bound, aiming at long-term rates is worth considering. Targeting interest rate levels rather than setting a target for the amount of government bond purchases appeared to be more sustainable and effective way to stimulate growth, he said. I think the Japanese experience could be utilized by other countries depending on the circumstances, he added. From Japan's experience, the key to controlling long-term rates successfully is to gain a strong presence in the government bond market. It is also important to develop and secure effective market operation tools to control yields while finding ways to keep some market functioning alive, he added. After years of heavy asset buying, the BOJ now owns more than 40% of the Japanese government bond market. Moving on to a more general article. Reuters, July 22nd, dollar euro flat as traders await Fed and ECB rate decisions. The dollar and euro were little changed on Monday as traders await decisions by the US Federal Reserve and the European Central Bank on how much and how fast they may reduce interest rates, beginning with the ECB on Thursday. Traders are Traders see about a 46% probability that European policymakers will lower a key deposit rate by 10 basis points to minus zero point 0.5 basis points to combat risk from global trade tensions and anemic regional inflation based on local interest rate markets. The market is just waiting for what Draghi has to say about policy, said Brendan McKenna, currency strategist at Wells Fargo Securities, referring to ECB President Mario Draghi. Rising chances of European interest rates sliding into deeper into negative territory pressured the euro lower against the dollar and propelled the Swiss franc to a two-year peak against the single currency. The greenback has been bogged down by bets the Federal Reserve will likely cut US interest rates for the first time in a decade and also respond in response to global trade tensions and weak inflation. Data published late on Friday showed speculators dialed back their net bullish positions in the dollar against other G10 currencies in their lowest level in a year. It doesn't look like they will be too aggressive with a cut next week, McKenna said. This is more of an insurance cut and not a start of a prolonged easing cycle. The US economy is still pretty strong. Over to Russia now, July 22nd. Russia's central bank seen cutting rate to 7.25% on Friday. The Russian central bank is expected to cut its interest rate on Friday after policymakers indicated that rate cuts were looming amid slowing inflation and sluggish economic growth, a Reuters poll showed on Monday. The 23 analysts and economists who took part in the poll on July 22nd unanimously predicted that the central bank will lower the key rate to 7.25% at the upcoming rate-setting meeting. We think the central bank will lower the key rate by 25 basis points at the following meeting, said Yaroslav Lisovic, head of Sberbank Investment Research. According to our forecasts, the next rate cut by 25 basis points will take place in September, Lisovic from Sberbank said. Reuters, will ECB walk or just talk as rates circus comes to Europe? So, just interjecting before I read this, the ECB may cut rates, or it may say it will cut rates in the future, hoping that just saying it will cut rates will have an effect. I will begin. The global march towards lower interest rates reaches Europe this week, with the European Central Bank expected at least to signal easier monetary policy, while Turkey's new banking chief is seen as taking an axe to the country's rates. Slowing global growth, increased protectionism, and in some cases weak domestic data have persuaded major central banks to loosen monetary policy, with a rate cut more or less inked in for the US Federal Reserve at the end of this month. The ECB, whose governing council meets on Wednesday and Thursday, said last month that Eurozone interest rates would remain at present levels, at least through the first half of 2020, an extension from the previous period of until the end of 2019. Two-thirds of economists polled by Reuters expect the ECB next week simply to change its guidance, such as for rates to be at present or lower levels ahead, with a cut for the deposit rate to an all-time low of minus 0.5% at its September meeting. I think for now they'll only get to the point where they consider a rate cut is on the table and then do it later. The ECB has a long history of moving very slowly, said Capital Economics Senior Europe economist Jack Allen Reynolds. But some economists believe the ECB will have to do more. Carsten Bresky, chief economist for Germany at ING, said he thinks the chances of just words as 51% versus 49% for action. Draghi has surprised us more often in terms of being ahead of the curve, over-delivering, but it's very hard to say. I think there will be a tough discussion, he said. If the Fed starts cutting rates and the ECB does not send out an extremely dovish message, the euro could strengthen, although at Friday's level of $1.12, it is hardly near the pain barrier for EU exporters. Commerzbank is one bank that predicts the ECB will act, cutting by 20 basis points. Maybe they want to prevent an appreciation of the euro, and like the US, they want to prolong the upswing. The data, though, is not as bad as you might think, said economist Bernard Waldstrainer. Unemployment in the Eurozone is at 7.5% at its lowest level since July 2008, while industrial production and exports improved in May, albeit after declines in April. Only 27 of 76 economists polled now expect an increase to British interest rates before the end of next year, compared to 36 of 69 last month. On the flip side, 9 of 76 were expecting a cut by end 2020 compared to 5 of 69 in June. We don't necessarily share the view that the UK economy will see a substantial pickup in growth, even in a smooth Brexit. Royal Bank of Canada is a primary dealer of British government bonds. Bank of England's Haldane very cautious about cutting rates. Bank of England chief economist Andy Haldane sought to push back against market bets that the central bank's next move will be an interest rate cut, saying he would resist lowering borrowing costs unless there was a sharp downturn. Haldane contrasted the BOE's stance with that of the US Federal Reserve and the European Central Bank, both of which are expected to loosen policy, and stressed again that even a disruptive no-deal Brexit would not bring an automatic rate cut. He acknowledged that business investment was strikingly subdued as companies struggled with Brexit uncertainty. My personal view, though, is that I would be very cautious about considering a monetary policy loosening, barring some sharp economic downturn, he said, an event for local businesses in Scunthorpe and northern England. BOE Governor Mark Carney and others have also deflected the idea that the Monetary Policy Committee is thinking of cutting rates while a Brexit deal remains possible. They say the pricing of rate futures has been distorted by the risk of Britain leaving the EU without a transition deal on October the 31st, creating a tension between the forecasts and market assumptions. Monetary policymakers are often cast as one-club golfers in the current conjecture. The problem is more that the MPC does not know which of the two quite different fairways it should be aiming at, Haldane said in his speech. With the economic road ahead potentially forking, the case for holding rates until the road becomes clearer is strong. Carney sounded less positive about the economy than Haldane when he said this month that underlying growth was running below its potential and relying heavily on household spending. Haldane used his speech to warn that markets and the public had grown too accustomed to ultra-low interest rates, a marked contrast in tone from 2016 when he defended sledgehammer stimulus after Britain voted to leave the EU. It is important that monetary policy is not a prisoner of its past, that the monetary cavalry are not called at the first whiff of grape shot, and that dependency culture around monetary policy is not allowed to develop, Haldane said. Supercharging the supply side of the economy is what is needed now, he added. Johnson says, the new Prime Minister, Johnson, says he wants to cut income taxes for higher earners as well as raise payroll tax thresholds, which would represent a major loosening of Britain's fiscal policy. Now to some of the effects of interest rate turmoil. Actually, I'll go back to that article again where he says something interesting here. Um, he says they are um, central bankers are often seen as belonging to the same golf club. And I wonder if that golf club is in Basel in Switzerland, where the Bank of International Settlements is located. Yes, here we are. Monetary policy makers are often cast as one-club golfers. So I assume that means it's not very subtle. But you could interpret that as belonging to only one golf club. That golf club being the BIS in Basel. Anyway. So July the 23rd, London Forex trading turnover surges to record high. Britain's daily foreign exchange turnover rose to a record high in April, and the Bank of England said on Tuesday as investors concerned about central bank policy U-turns sought to protect their portfolios. So this is already having an effect on investors. The BOE's semi-annual survey, which showed daily average FX turnover in Britain jumped 12% to 2.86 trillion in the 6 months to April, underlined the rude health of London's foreign exchange industry, despite worries about the impact of Britain's departure from the European Union. London's forex market, the world's biggest, is the crown jewel of Britain's financial services industry. On the other hand, currency trading volume in North America fell sharply in April, according to the New York Federal Reserve's own semi-annual survey. The biggest contributors to the record volumes in London were a 23% jump in foreign exchange swaps to $1.46 trillion in October 2018 and an 18% rise in currency forwards. The surge in turnover came despite a volatile period for financial markets as stocks sold off heavily in December, forcing the world's major central banks, led by the US Fed, to make a U-turn in tightening policy. However, volatility has been stuck near multi-year lows as central banks appeared to turn dovish in tandem, removing the policy divergences that investors betting on forex markets like to see. So they're all moving in lockstep, in other words, and volatility is is like volatility is like energy in the market, and the energy is going out of the market for forex anyway. UBS wealth management forex strategist Daniel Trum said US interest rates were still among the highest in the developed world, even as the market price in Fed interest rate cuts. The market prices in Fed interest rate cuts. The jump in turnover was very likely due to hedging activity given the high interest rate differential with the US, he said, pointing to US investors in the UK and British investors in the United States as likely the most active. Uncertainty surrounding Britain's departure from the European Union had also supported volumes, Trump said. Volumes in spot and non-deliverable forwards were broadly stagnant over the 6 months, according to the BOE survey. Turnover in euro-dollar and sterling-dollar currency pairs rose 18% and 16% respectively, posting a record average daily high. Dollar Chinese yuan turnover increased 6%, and trading in the currency pair again represented a larger market share than that of the euro sterling. The growth of offshore yuan trading, albeit from a low base above euro sterling volumes, comes despite many participants using the single currency and pound to express their view on the Brexit negotiations. Lastly, we come to China. This is July 23rd. PBOC chief says current interest rate level is appropriate. China's central bank governor Yi Gang said the country's interest rate level is appropriate, the financial magazine Caixin reported on Tuesday. Chinese policymakers are keen to fend off a sharper slowdown in the world's second largest economy that has been pinched by a bruising trade war with the United States. Yi said in a recent interview with Caixin that whether the People's Bank of China, PBOC, follows the Federal Reserve in cutting interest rates will depend on China's own economic conditions. Overall, our current interest rate level is appropriate, Yi said. Cutting interest rates will mainly deal with the danger of deflation, but price changes in China remain moderate. Yi did not clarify which interest rate he was referring to. The PBOC has kept the benchmark lending rate unchanged since October 2015. China is keeping all its economic policy tools within reach as the trade war with the US gets stronger and costlier, but still sees more aggressive action like interest rate cuts as a last resort should the dispute get uglier, policy sources have told Reuters. So there we have it. The trend towards global interest rate cuts is baked in. Bank of China is nervous about committing to anything because of the trade war with the US, which could go in either direction. And the British Bank of England is nervous about Brexit, and particularly nervous, it seems, because the forecasted economic disasters have not happened, and in fact, they've really done quite well. So, further developments doubtless will be seen and updated. I will. That's it for now, but I will add a uh, additional piece to this video when the ECB announces uh, its decision on interest rates.
And also, the nominal wage
So
growth
here we
is
have
above
the
historical average.
delightful
Household
Mario
wealth is
Draghi making
also
his
support.
announcement.
All these elements support consumption.
So I'm going to just summarize what was said. Basically, nothing's happening today, July the 25th. They will uh, engage in monetary easing, a more dovish monetary policy in September. That will probably be a rate cut. And it was asked by a journalist in the crowd whether it was considered for today. He said, no, it's not been considered for today. And other nuances were discussed, but not that. So in short, the ECB has not changed interest rates, but will do in September. So I'll leave it at that. Thanks for listening and watching.